Hey everyone, my name is Gareth and welcome to my Finance Fitness YouTube channel. This channel is going to be focused on personal finance, investments, real estate, financial freedom. So if any of those topics interest you, please consider subscribing to the channel. Today is my first video and we're going to be talking about real estate investment in 2020 and whether it's a good idea or not. Real estate markets around the world have done really well for the last 10 years or so since the last financial crisis. We've seen over 60% price increases in the US and similar percentages in the UK and Europe. A lot of this has been on the back of strong economic performance, low interest rates and low levels of unemployment. But in 2020, a lot of this has changed. We've experienced this big external health shock that's really had a big impact on economies around the world. Many countries have imposed lockdowns as they try to flatten the curve of the spread of this illness. This, of course, has had a big impact on many companies and their ability to operate. Many of them have had to let go of some of their staff, which has put financial pressure on families. We saw an early impact of this in the stock market. The stock market often serves as a leading indicator of what's happening in the economy. And what we saw in March was a very sharp drop of over 30% in the stock markets in just 3 weeks. This was the fastest bear market following the longest bull market in stock market history. Already we've seen unemployment numbers in the US increase as 42 million people filed for unemployment since March. And this is a really big number. I mean, to put this into perspective, it's the same as the entire populations of New Zealand, Ireland, Norway, Finland, Denmark, Singapore, Congo and Panama all combined. And that's just for the US. And so when you have so many people no longer working and no longer earning a salary, it affects their ability to meet their monthly financial commitments. For most of us, one of the biggest financial commitments we have every month is the roof over our head and being able to pay rent and mortgages. And now that so many people have lost their jobs, it will really affect their ability to continue to pay the rent and mortgages as they have in the past. Another new record we saw during this period has been the amount of government intervention. Governments around the world have stepped up and provided stimulus packages in an attempt to keep their economies going during this difficult time. These stimulus packages normally focus on companies and people, where companies are given loans or financial aid to tide them over this time so that they can continue operating and not have to retrench as many staff. The financial support to people usually comes in the form of a stimulus check for a temporary period to help them pay their living expenses. In 2020, we've seen bigger stimulus packages than ever in history. And so, history tends to repeat itself. And if we look at what happened in the past, we can better understand how to navigate this current situation. The 2008 financial crisis was largely fueled by what they called subprime mortgages. Now these subprime mortgages is basically just where banks had very relaxed lending criteria and were lending to people that had a very low chance of actually being able to repay those loans. Many of these people were not earning enough money, gave small down payments, didn't have adequate credit scores or collateral to put down against the loans that they made. And with the money from these loans, many of them went out and purchased real estate. This increase in demand for real estate pushed up the prices to unsustainable levels and eventually the bubble burst and the prices came tumbling down. If you're interested to learn more about what happened back in 2009, watch the movie called The Big Short. It's got some great actors in it, Brad Pitt, Christian Bale, Ryan Gosling, and it gives a bit of a Hollywood spin on the events of 2008 and 9. Stick with me to the end of this video and I'm going to tell you what I plan on doing and whether I'm going to invest in real estate this year. So now that we understand what fueled the 2009 recession, what's different this time around? Well, back then, the source of the recession, as I mentioned, was these subprime mortgages. But this time around, that's not the case. This time around, we're looking at a health pandemic that have brought economies around the world to a halt. One thing that's really interesting is that the price of the stock market and that of the real estate industry do not follow each other in sync. In fact, the stock market bottomed out in around March 2009, but this was not the case for real estate. Real estate actually only bottomed out 2 to 3 years later. Now, the first real estate investment I ever did was back in 2011 in Cape Town, South Africa, with a friend of mine. And at the time, it happened to be the bottom of the market. And I think this was partly luck, but it was also because leading up to that investment, we'd have noticed this dislocation between stock prices and the real estate prices. Since we invested close to the bottom of the market, that investment worked out really well, and it taught me a lot about what drives real estate prices. So if we now know that in the past there has been this 2 to 3 year delay between stock market movements and real estate movements, does that mean that we should wait 2 to 3 years before actually investing in real estate? So we've seen interest rates around the world come down quite a lot. In the US, it's close to 0%, and similarly in the UK and in Europe. Some countries are even at negative interest rates, like Japan. Some developing countries like South Africa, where I'm from, have cut even more aggressively, and they've cut their interest rates by over 2.5% since this pandemic. So with lower interest rates, it means that people that have debt now only need to pay a smaller amount to service that debt every month. This means that at the end of the month, they have a little bit more money left, which they can either spend or save and invest, both of which have a positive impact on the economy. Leaving your money in the bank or in a saving account at such a low interest rate is not really attractive, so it incentivizes people to either go spend that money, which boosts the economy, or invest it in something else. So in general, lower interest rates is a positive for real estate prices. Now, when the economy is struggling and consumers are under pressure and many of them losing their jobs, the banks react to this by increasing their lending criteria. Some of the ways they do this is to increase the minimum credit score you need, increase the down payment or the collateral, or increase the interest rate that they charge you on the loan. And with this higher lending criteria, it means that many people will no longer qualify for a loan. And with less people able to qualify for a loan, this will be negative for real estate prices. Now, as I mentioned earlier in this video, there's been a lot of governments offering stimulus packages. And these stimulus packages to individuals come in the form of checks. And as families receive these monthly checks, this helps them to cover their monthly living expenses, which means they're less likely to default on their mortgage repayments and credit card payments. And as a result, there will be less foreclosures on real estate. This will be a positive for real estate prices. Now, it's nearly impossible to predict in the short term whether real estate prices will be going up or down. There are so many factors that can affect this. For example, things that could push property prices up would be low interest rate, good unemployment numbers, a strong rebound of economies following this lockdown from the pandemic. Things that could push the property prices down further could be if economies take longer to recover or we see a second wave of the infections. So if you're looking to make an investment, know that it is possible that prices would still decrease before they bounce back. Overall, there are always opportunities to invest, and during this period, it could be a great opportunity for you to add real estate to your portfolio. And this is exactly what I plan on doing this year. I've already seen many new units coming onto the market, and units that were on the market previously have experienced significant price reductions. Now, it's important to be patient because it's very possible, like I mentioned, that prices could continue to go down. So before you buy a real estate, make sure you look at prices carefully and do your homework. But when you find the right home at the right price, this could be a great opportunity for you to get a good deal. Please be sure that you subscribe to this channel because in my next video, I'm going to be looking at different types of real estate investments. Now, as Warren Buffett says, be greedy when others are fearful and be fearful when others are greedy. Right now, there is a lot of uncertainty and it could present an opportunity for you to secure a good price for an investment. But with every investment, there is risk. So make sure that you assess that risk and do your homework before purchasing a property. It's also important, especially during this period, that you don't overextend yourself and don't borrow more than you could reasonably repay. This could add unnecessary financial pressure to you, especially when a lot of people are still losing their jobs. I also always recommend to keep a bit of a cash buffer, just in case some unexpected expenses pop up, so that you can still cover those without being too stressed out. In the comments section, let me know if you plan on investing in real estate in 2020. I'm really keen to hear what your plans are. Thank you so much for watching this video. I really appreciate it. If you enjoyed it, please give it a thumbs up, and I'll see you in the next one. Thank you very much.